Today being April 3rd, 2025. Of course, last night after market close, we, in all of its glory, got to experience Liberation Day, whereby President Donald Trump announced tariffs in addition to the previous tariffs that have been announced thus far. These new tariffs to be implemented on top of that. I want to take a look at the tariffs with you today on this video, and I also would like to take a look at the market reaction and give my thoughts on that. So first off, let's take a look at the tariffs. Of course, China being at the top, we've slapped a 34% tariff on top of the already imposed 20% tariff, meaning that imports from China are now tariffed at 54%, the European Union 20%, Vietnam 46%. How many companies relocated their manufacturing from China to Vietnam over the last few years, thinking that they were insulating themselves from volatility? Well, guess we're doing away with that. Taiwan, 32%. Japan, India, South Korea, Thailand, Switzerland, you name it, we are going crazy with the tariffs. Here's what I want to discuss first. This in this chart in the right column here is a column labeled tariffs charged to the USA. Well, sleuths on X were able to take a look at what that actually meant. This gentleman here, orthonormalist, was able to figure out that the tariffs charged to the USA column is actually equal to the trade deficit divided by the nation's exports to us. Not exactly tariffs charged to the USA. Here's what I would like to think is going on. Here's what I would like to hope is going on with these tariffs. What I would like to hope is, again, the stated goal is to stimulate domestic manufacturing and put wealth into the pockets of more common Americans. Now, of course, we know that our economy and trade paradigm has made many Americans very wealthy. In fact, America is the wealthiest nation on earth by many, many non-disputed metrics. In terms of nominal wealth, for sure. Our pattern of outsourcing manufacturing of low-level goods through comparative advantage, of course, has created wealth for Americans, particularly American shareholders of American countries based in the US, cheaply manufacturing goods off of using American intellectual property and then selling them in America at higher margins. So, assuming that these tariffs stick, what is really going on, I see, is China is the apex target of this. China is the target. Of course, China, in many ways, is our adversary. Look at through the lens of Ray Dalio's global economic order discussions, where he's talking about how long-term interest rate cycles happen to coincide with a new great power testing the dominance of the preeminent superpower. In this case, China would be the new great power, testing the preeminent superpower that happens to have the world reserve currency, of which we in the United States are filling that role. So what I see going on with these tariffs is we're really targeting China, and there's all this collateral here that will create a lot of very frustrating negotiation for these countries. My hope is that the strategy here is to get these nations, the nations that do happen to actually impose tariffs, to get those nations to create a more favorable environment for our goods. Now, is that a great strategy? But I think that another thing that's going on here is the Trump administration has made very clear that what they want to see is interest rates come down. And what I think is going on here is kind of a shock and awe tactic to get interest rates down so that we can refinance some of our debt at lower interest rates. Of course, when Trump was reelected, interest rates went up quite a bit. To aid me in that, I will take a look here at the 10-year yield. So, what did we see about this time last year? Interest rates, the 10-year hovering in the high fours. It actually came all the way down to the mid threes, started to rise. Well, what happened here was that when Trump was elected, 10-year rallied, well, it sold off. When interest rates are going up, that does imply that inflation expectations are also going up. So inflation means higher interest rates. Deflation is the opposite, of course, among other things. Now, the administration has made many comments. This here in Fortune magazine, I don't have the subscription, but this is March 23rd. Treasury Secretary Scott Bessent can't stop talking about 10-year bond yields. Speeches and interviews week after week, he states and restates the administration's plan to push them down and keep them down. So you see what's going on. What used to be often mentioned in the bond market is the idea of don't fight the Fed. It's somewhat evolving into don't fight the Treasury. Very important. The administration, particularly Bessent, has repeatedly stated that they want yields to come down. The Fed, of course, did lower their target funds rate here. In fact, they basically marked the bottom. The moment that they started lowering interest rates, actual interest rates on treasury bonds started going up. That's not a good thing. That means that the Fed has somewhat lost control of managing inflation expectations. And then you've got Mr. Bessent. His whole goal is to manage the finances of the Treasury. So, of course, his goal is to bring 10-year yields down, to bring all yields down. They have said repeatedly, I've seen many, many rumors emerge over the last several months, while Donald Trump was so fixated on the stock market in his first term. What Bessent has now convinced him of while talking in his ear is that we need to not care about the stock market, and instead, everything that we do needs to be oriented around interest rates coming down. Now, I tell you what this does accomplish here, these tariffs, those should tank interest rates, right? Because having such sweeping tariffs, it destroys business confidence, business certainty, pricing confidence. Having such sweeping tariffs throws a huge rent in demand for all goods, even if temporarily. So for them to guide to this, they kept guiding to this 10, 15, 20% tariffs across the board. Well, now we see that it's much worse than that. So what happens? 10-year yields drop like a rock. You see, down 40 basis points in a week, 30 something basis points in a week, down almost 80 basis points from the peak in January. Interest rates are coming down. Bonds are rallying. Now, of course, they're not where they were even less than a year ago, but bonds are rallying. They have made it very obvious to me that they are, this is the number that they're watching. Well, look, you see here, bond prices have gone up. Throughout all of this trade talk, bond prices have gone up, whereas stock prices have gone down. So that's what I think they're doing here is they're trying to get 10-year rates to come down. And then there's an ancillary goal of negotiating better to getting some countries to lower their tariffs on us. And furthermore, if these negotiations don't work out and we just leave these tariffs and we still are importing some of these goods despite lower demand for those products, we'll raise revenue and at the same time make a substitute product in America more competitive. So I think that there's a lot of reasons to be critical of this tariff proposal. I think it's a negotiating tactic. Do I think that there's a strategy here? I don't know, but I do think that based on what I see and believe, where the administration has made clear that we're going to get these interest rates down, that's exactly what's happening and it's working. Okay, so I think that's how I would look at tariffs. Now, let's take a look at how markets are reacting. Of course, the S&P 500, more specifically the SPY ETF, down 4 points. Dow down 3. The QQQ down 4.5%. It's pretty severe, right? Tech stocks down 6%. Energy down 7%. In fact, the only sector green on the day is consumer staples. We'll come back to that in a moment. Global markets down. In fact, we see Brazil here is rallying today, whereas markets elsewhere down, but not as steep as ours. So no wonder equity markets hate this, what's going on. All in all, uncertainty, markets hate. So we're seeing that. Meanwhile, bonds are rallying with the exception of junk bond. Now, a couple things. The fact that bonds are rallying, oil prices down by 6 points. We don't have, interestingly, Bitcoin only down 1%. Bitcoin's performing pretty well today. Interestingly, of course, it's been a bad year so far for the major cryptocurrencies. And then we see gold today down 70 basis points. So when you look at energy commodity prices, natural gas is rallying. I think the reason natural gas is rallying is because of North American natural gas remaining somewhat strong in terms of demand throughout. But we see here that crude oil down major. Of course, when oil prices are going down, inflation is coming down quite a bit. When oil prices are going up, it's highly inflationary. It would be better if we looked at this, which is futures on WTI crude. You see here, June 2022, crude oil hit 120 bucks. Okay. So what happened in the quarters that followed? CPI ballooned, right? And stocks cratered after that. But when crude oil is that expensive, it's highly, highly inflationary. Okay. So crude oil selling off means that market participants think the opposite is occurring with these tariffs. The market does not think these tariffs are inflationary, folks. They think they are deflationary. We see that precious metals are selling off. Commodities are somewhat flat. So stocks selling off, deflation. Bonds, what's going on here? This looks different. These numbers don't look requisite with what I'm seeing because every bond position in my portfolio is up about 1% today. And again, if we look at here, 15 basis points down according to this. So I don't know what's going on here or when they're recording that from. But we see here bonds rallying. So what I'm trying to say is that interest rates coming down, oil prices coming down, gold selling off, Bitcoin selling off, and stocks deeply selling off. Seems to me that the market believes that all of this is deflationary. Prices coming down, demand coming down. That's what that says to me. So if the main goal of the administration is to lower interest rates, what they're doing is working. And if there's some sort of collateral ancillary payoff of getting better trade deals, well, that might work, it might not. I don't know. But clearly, what it's doing is it's creating a ton of volatility, right? So we have to be careful. We have to be careful in terms of our investing decisions. Now, when it comes to my portfolio, the two biggest sectors are energy and consumer staples. But one thing that I've covered over the last year is this company here. In fact, here you see my article here, rated a strong buy, March 28th, less than a week ago. But we see here what's going on, 3.5%. In fact, we should just look at tobacco in general. You see what's going on here. The big four, I don't even pay attention to these others. Position here, don't have a position here or here. Okay. But you see what's going on here. Investors are fleeing to safety. What else is going on? The number one holding in this ETF, Costco. Costco haters are in shambles right now. Why is such an expensive stock trading up? Well, I'll tell you why. Limited international exposure. Consistent gross margins. Costco tends to do well in bad economic environments because consumers trade down into value. That's not surprising to me. Procter & Gamble also doing well. Walmart, not as much. Why? I don't know. I think this might come down to the difference in model between Walmart and Costco. More international presence, perhaps. Coca-Cola Company, very good performance. Philip Morris, we looked at that. PepsiCo, that's another holding in the portfolio. Doing pretty good. Mondelez, also doing well. So here's what's interesting. I'm gonna neglect to look at Costco because that doesn't really fit what I'm trying to say. But I am gonna pull up this chart. I think I covered this. I talked about this the other day. I mean, let's just keep adding as many consumer staples as I can think of. So this is what I'm trying to illustrate. So you see what's going on. This blue here is the S&P 500. Now we know that the S&P 500 is very top heavy with tech. That's driven a lot of returns. Furthermore, there's been a lot of multiple expansion. You see how much different the performance of the S&P 500 is versus Coca-Cola, which has been relatively flat. You have some of these other names, but all in all, the pattern is more or less Flowers Foods is actually down on a total return basis over this time. But the idea is from this point on, there's this huge divergence where the S&P 500 has far surpassed consumer staples as a sector, far surpassed the returns. And, as such, you have stocks that in the long term have performed very well. In fact, I'm going to switch to total return to illustrate this point even further. So you see in this chart, this is going back, 30 years. So April 3rd, 1995 is how far this chart goes back. Out of all of these tickers, only one has underperformed the S&P, and that's actually Coca-Cola. Every single other one has significantly outperformed the S&P by multiple hundreds of percent, okay? So that gives you an idea that these have been good companies, okay? But what we're seeing here, you see a significant divergence over the 5-year performance, where the opposite is true, where the S&P has significantly outperformed and Coca-Cola actually is the next closest. But all of these other stocks have significantly underperformed and have been fairly flat over that time frame. Okay. So what has that been telling me over time? Well, what that's been telling me is that if the market were to rotate, if the market were to face challenges, there might be a rotation back into staple names. There might be a big rotation. And I think what I'm seeing today is somewhat, I don't want to say it's vindicating that thesis, but it's certainly giving weight. Utilities also doing okay. Energy is a good trade for the inflation and stagflation scenario. So I'm heavy in that because I want to wait and position for that. But consumer staples is a good trade for a rotation, the rotation out of tech. Okay, and you see here, of course, technology also doing very poorly. In fact, if we navigate back here, we see Tesla down 4.5 points, Apple down 8.7, Google down 3%, Amazon down 7.5. That's all I have in this little thing I'm watching here. But that gives you an idea that over the last year, I've been positioning my portfolio in anticipation of eventually there being this rotation into staples. And I think what we're seeing today is creating that. I've also accumulated a position in treasury bonds. So, what I'm seeing in the markets right now is that interest rates are coming down, the inflation regime is being stamped out by the administration, and they are clearly willing to generate a lot of collateral damage from that. My hope is that we are able to negotiate good trade deals without destroying our relationships with other countries. That remains to be seen if it will happen. If these tariffs do go into effect the way that they're listed, um, it will create massive disruption in certain things. I'm not smart enough to be able to tell you in what things without doing much more detailed analysis, which I have not done up to this point. However, I do believe that the market has been very afraid, and there's been a lot of talk of inflation. And what we're seeing here is that the market expects the opposite of that with this tariff news. And consumer staples, as far as equity sectors go, in American stocks, that is the place to hide today. Out of all the asset classes that I've listed, between crypto, precious metals, commodities, bonds, equities, only consumer staple equities and bonds are green today. So do with that information what you will. I think it's quite interesting. As for this calculation, the trade deficit divided by the exports, I think we see what's going on here. That this is unserious and inflammatory, meant to provoke a conversation. I just hope that it leads to a good outcome. But I think what's clear is that we are going to see volatility. We are in a volatility regime going forward. And I think when we're looking at making investment decisions, we have to position ourselves accordingly. So that's going to be it for today in terms of that discussion. But let me know your thoughts on that. Comment below. Let's discuss. Hope you've enjoyed watching. Thank you for watching. I appreciate it. And be sure to like the video and subscribe if you found this useful and interesting, and you'd like to see more like it, because I'm doing this kind of stuff very routinely. So anyways, it's been fun. I'm going to sign off, and I will talk to you